Welcome back. Here with Money, 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 and this week we're in conversation with NIMESH of ICICI Prudential Asset Management Company, telling us which funds to be and how to make money in financial year 2018. So, NIMESH, everybody, including my mother, knows that the FD is not going to get you anything, especially after paying the tax on it. People are really looking out for interesting debt fund options, but it's a complicated world. What sort of fund would you advise a retail investor?
It's not a complicated word, but it is very badly understood. It's not fully understood in India, yes. The debt fund segment completely. Yeah. See, essentially, what do we do in a debt fund? Either you are playing the duration, that is when you are expecting interest rates to go down over a period of time, then you give an active duration call, right? That is, you are investing in a duration. You take 10-year paper, interest rate goes down and you benefit. That's what I told you last year when I came on your turn. I was banging on that we should invest in debt funds, and last 1 year, debt funds have given fantastic return. So now that story, a lot of that story is over, but still there is again a spike in interest rates. So
last policy being hawkish and the market wondering now if the rate cut cycle is over.
But again, look at this, that inflation targeting is anyway at 4%. You are talking about a CPI inflation rate of 4%. That is what the government is targeting. And our yields are quite high compared to that. Why should you have so much real interest rate? So I believe that real interest rates will be lesser and those yields will come down over a period of, and you will see that in the next 1 year also. But one has to understand the tax status of yourself before you invest, because then you will have to hold on for 3 years if you want to have a good tax status.
So you're saying that if someone is not thinking of taxation, is purely looking at returns, then play duration, but for a short period maybe, because then at some point
otherwise you are smart enough, calculate your duration return in say 9 months time. If the interest rates go down by 1%, what will your, or 0.5%, what will your returns be on the fund? Pay the tax, then also you will be better off with any traditional fixed income instrument. That is one shot. Second one is that another very good segment of that we run is the corporate bond market. Right, so we have funds like ICICI Prudential Regular Income Fund, Regular Savings Funds, etc. So ICICI Prudential Corporate Bond Fund, which invest in primarily AA rated companies and above. We charge our fees and the rest of the return is for the investor. So if you got a 3 or 5 year view and you don't want to take risk, we went through the whole risk parameter. We went to infrastructure fund, then we came to focus blue chip fund, balance advantage fund. In risk, slowly the risk is decreasing. Now you don't want the fluctuation of even a balance advantage fund, and you don't want equity, then ICICI Prudential Regular Savings Fund or ICICI Prudential Corporate Bond Fund, which primarily invest only in debt, and we deduct our fees, and the rest of the this one is for investors. So
but if you're talking about a corporate bond fund, then what about the credit risk? Is that something investors should be aware of?
So in a corporate bond fund, primarily we invest only in bonds which are rated AA and above. Right, last 5 years, 6 years, the experience for the investors has been very good. I think a common man in India can afford to invest in a double rated company. The risk is acceptable. So you are in that also, if you are very risk averse, then please go for ICICI Prudential Corporate Bond Fund, which invests primarily in AA rated companies. Or there is ICICI Prudential Regular Saving Fund, which will have slightly, we will have some papers in A4, A plus category and A single A category also. But it will give you slightly more return. But credit risk is associated with that fund. You can't run away from credit risk. So what do? We spread amongst many products. It is spread. If it's a single A rated company, I'll give only 2% of my fund. So we know how to manage that risk, and we have been managing that risk quite a long time.
And so these would be type of accrual funds that we're talking about.
It is accrual fund. So then you should remain in that for 3 years. Don't have a shorter time. So now what has happened? In equity by nature anyway, you have to stay for 3 years. And debt funds, for getting the right taxation also, you need to stay for 3 years. So the retail investors should look at mutual funds only if he has a 3-year perspective. Otherwise, he should not look at mutual funds.
That's a fair point, and it's a point that people should remember out there. But let me just ask you now for some closing thoughts on other asset classes that might actually vie for people's attention this year. Real estate has been an interesting play, and of course nothing has moved out there. If you think that could come back, what do you think of gold right now, and other avenues of making money, or do you think it's actually going to be mutual funds?
No, real estate at some point of time, I don't know whether it will be 17-18 or 18-19. As real estate is going, in Bombay it is going through time correction, and rest of India also there is a price correction also. A lot of parts of India, it's an individual market. But I believe in the long term, it's it's a good asset class. It's a very good asset class, but it was slightly, any asset class which has gone up very fast for a period of time will go through its lull. We have seen it 90s also, from 94 to 2002, nothing happened in real estate. 2002 to 2012, real estate, 2003 to 2012, real estate has had a good run from 2004 to 2012. So we are seeing a phase where real estate is consolidating. The problems, the regulatory framework that is coming in. Mutual funds are a good play because it is regulated very well by SEBI, right? You know what you are getting into. I think the regulations that are coming in real estate will make it more disciplined than what it was in the past. I should have the assurance that if I'm giving money in 3 years' time, I'll have my flat. Investing in corporate real estate, that is on, which is the rental yield business, which is at 9-10% is a good rent. I think over the next 2 years, a time will come when I'll come back to your show and say that real estate is a good investment. Right now, the yields on investing in a flat in Bombay is 2%, while you will have to pay your bank 9%. So how can that be a good play? I want that yields to shrink. And there is a huge control coming on black money also. So I believe with all that happening, real estate will be a more disciplined play in, say, year 2018-19. It will be much more disciplined than what it is coming today. Let the base asset be more disciplined, it can be a good play.
Well, let's see. We are definitely interesting times. Thanks, Nimesh, so much for shedding light on a lot of those issues and taking us through, of course, your personal favorite funds as well. FY18, hopefully it's going to be a great year for everyone. Well, that's it on this episode of Money, Money, Money. Thanks for being with us. Your feedback, comments, queries, welcome as always. Our email ID is on your screen. We'll see you again next week.